Passive stress-free investing. Doesn't that sound nice? Shouldn't that be the goal? I mean, time is our most precious commodity, so how we spend that time is vitally important. I want to use my time in the most impactful manner possible. Maybe I should be looking at real estate. Maybe I should be looking at my job or maybe my business, right? Where can I have the biggest impact? I don't think it's necessarily looking at one individual stock, investigating hour after hour, trying to determine if Alibaba is the way to go. Should I buy, sell, or hold? Which I've done recently. I spent a bunch of hours trying to determine if Alibaba was the stock to buy. But I want to show you today that you don't have to think that way. You can probably have a huge impact in your stock portfolio and not even think about what you're doing. You can just turn it on and walk away. Hi, my name is Dave, and on this channel we talk about building wealth with the idea that we're going to show other people that financial independence can be achieved with the right tool, the right plan in place. So today I want to walk you through an idea, which is how can I use my time wisely when it comes to stock market investing? Stay tuned. Whoop! I started thinking about this video a few weeks back as I was doing a deep dive into Alibaba stock. I was doing my research, checking out every chart I could find, watching other people's videos, and then I realized Charlie Munger just bought a bunch. Success leaves clues. He's a brilliant man with a brilliant staff. That's probably the most impactful reason that I actually bought the stock. But, it doesn't make me an expert on Alibaba. There's so much going on with an individual stock, so many things in play when you buy an individual stock that I probably shouldn't be focused there, right? I could save all that time and put it in other areas where it could have a bigger impact, like we mentioned. So my plan is to stop focusing on individual stocks and really start focusing on the broader market with the bulk of my money and my investing in the stock market. I can have a much bigger impact in those other areas that I mentioned. So that's my plan. And I want to show you today exactly how you can do that as well. I do want to emphasize that being involved in the stock market is really important. We just don't have to be obsessive about it. We don't have to check it 8 times a day. Maybe we check it once a week, once a quarter, once, a year even. Can you imagine? Where we're just not obsessed about it, but we're in the right products for the long term. Can set it and forget it. So what we're really trying to do here is truly set it up so that we can turn and walk away and have confidence that when we check it once a quarter, we're going to be happy with the results in the long term. I am fascinated by all the research when it comes to people trying to beat the market. But if you ever talk to any of these professionals, it seems like their advice is pretty consistent. Don't mess with us. We've dedicated our lives to this profession, and you haven't. So if you don't have enough time there, just go buy some ETFs. I recently read this book here, right? This is Money Masters. Money Master the Game by Tony Robbins, but inside of this he talks a lot about with Ray Dalio about his all-weather portfolio, and it was pretty fascinating. But when he's talking about the all-weather portfolio, he's basically trying to take out the highs and lows for you, remove some of the emotion, keep you in a solid product over time so that you can grow your wealth, and you don't have to worry about it so much. You can look at it once every 6 months and adjust as necessary. In the meantime, you get to take all that time that you saved and you get to put it into other areas where you truly probably can have a bigger impact. Another one for me is Warren Buffett, a brilliant man, has had huge success in his life. And when he was asked, here are a couple quotes from him, by periodically investing in an index fund, the know-nothing investors can actually outperform most investment professionals. I think that says it all, right? Don't mess with us. Invest in your low-cost ETFs and save time so you can do it in other areas. Another great Warren Buffett quote was, in a 2014 open letter to his shareholders. He was asked about, if something ever happens to you, how are you going to take care of your wife, this person that you love, right? And he says, my advice to the trustee could not be more simple. Put 10% of the cash in short-term government bonds and 90% in a very low-cost S&P 500 index fund, or ETF, I suppose, right? So his 90-10 idea, right? Keep it simple, and then you have time to focus in other areas. So there are many ways you can set up automatic investing. You can use Fidelity, you can use E-Trade, you can use M1 Finance. I particularly like M1 Finance. I've been using it a lot lately, and I've been doing some demos here on this channel. So that's what we're going to use today because it's very user-friendly for first-time users if you want to set up automatic investing. So let's go over there, and we're going to take a look at some of their products and some ways that you could get this set up and you could start automatic investing. Okay, so I'm logged into my M1 account, and this is what it looks like if you're not familiar with it. I will link my one-year review above just so you can get an understanding of how the Pi idea works, because I'm not going to dive into that right now. But it's very simple to set up a bank account so you can auto invest into this. And then what I want to show you today is if you go click under research and you look at expert pies, you're going to see all kinds of examples of pies that you can just click into and start investing today. So let's look at this general investing. Let's say you like that idea that Warren Buffett has of that 90-10, right? 90% being in a broad-based S&P 500 index fund with 10% in bonds. Well, if you come into here and you click and you look, okay, well, here's a bunch of different examples ranging from ultra conservative to ultra aggressive. And this is just one example. You can also see the return that those have been providing. So let's say we're ultra aggressive. We're a young person. We're pretty happy with being pretty aggressive at this point in our lives. Well, that's returned 94.7% over the last 5 years. And simply by holding these 7 ETFs. And that bottom one is that bond ETF at 1%. So if you wanted to jack that up to 10% and mirror that 90-10 idea, you could do that. But between VNQ, VOO, and all of these other broad-based ETFs, you're buying just about everything, whether it's developing markets or emerging markets or the broad market here in the United States. So just by that simple implementation, click add to portfolio, you're going to get that little dividend, small expense ratio. You're going to be on the path where you can turn, walk away, focus on everything else. So one final item just to kind of hammer this home is this right here is a list of a bunch of ETFs that you'll find right on the M1 website, and you'll see the 5-year returns. And this very first one, almost 18%, another 17.5%, and these are just broad-based. Here's one 22%, right? So a lot of these are exceptional returns over 5 years. Within 1 year, you're having here 45% for this VTI and 41% for VOO, which is just the S&P 500 ETF. So let's stay focused on that 5 years. And if you start looking at that and comparing it to ETF returns, which I'm going to grab from here, this is the Balance website. And this is the average mutual fund returns in 2020 and the long term. So this is as of December 22nd, 2020. So they would have had a little bit more of a pump since we've had a nice first half of the year here. But they're looking at a 5-year return of about 13%, and it tapers off from there depending on what area you're in. Obviously, we're not thinking about bonds. We're thinking about large cap stocks here. But these are paid, professionally managed mutual funds. These guys are paid to beat the market. That's what they're there for. But just like you and I, they are emotional. And they also get to charge you high fees for managing your money. But it's been proven time and time again that the vast majority of them fail to beat the market, and that's why ETFs are a better choice for you. And that's why I steer away from mutual funds. So that's just one more example. The stats are in our favor to buy these types of ETFs. So that's where I stay. I think the most important thing here is that you get started today. You start putting something in there every week, every month, so you can start building up your portfolio. There are so many great options within here. You can start slowly tweaking them, right? So if you want emerging markets or higher dividend yield, you can do that. You can switch over from VOO, Vanguard S&P 500 ETF, to something like VYM, Vanguard High Dividend Yield ETF, right? And that by itself will give you about an extra 1.5% off the top if you want to do that and actually have some income coming in. So there's lots of ways to tweak these and play with these. The important thing, you get started today. For more content just like this, please like and subscribe and ring the little bell so you'll be notified whenever new content is released. So I hope that illustrates why we don't have to be so stressed about the stock market. We don't have to spend countless hours trying to figure out exactly which stock to buy. I know that with the bulk of my money, I'm going to be doing this, but I do like to buy the individual stock at times. I dabble a lot in the stock market, and I do a lot with trading options as well. So I end up owning different things at different times. But I think for the general person trying to get involved into the stock market, which you should be doing, that this is the way to go. Keep it really simple. Don't stress about it. Turn, walk away, ignore it as much as possible. So thanks for listening. If you have any questions, just ask down below. So please like and subscribe. Join us here. We'll see you next time. Whoop!